Did you know that the Chinese EV market has taken a dip? With the economy in chaos and supply saturated, Chinese EV manufacturers are scratching their heads. Want to know what this means for investors? Chinese EV company Zeekr Intelligent Technology Holding went public in the US in early May 2024. This is significant because currently Chinese EV shares are trading at half the price due to the Chinese EV market crash. Moreover, affinity for Chinese stocks, let alone those belonging to EV companies, are not that great in 2024. In spite of the threat of imposing sweeping tariffs on EV makers in China, the US has not done so. Hence, Zeekr has a successful IPO. Its share price jumped almost 35% on its first day of trading after pricing its IPO at $21 per share, at the upper end of its price range. The stock has since pared its gains and trades at just below $27. It is important to note that Zeekr is backed by Geely Holdings, which is owned by Volvo and Polestar brands. It's a luxury EV manufacturer, and Geely has previously performed well in international markets with gas-powered cars. What remains to be seen is how well it's able to promote its subsidiary amid woes in the Chinese EV landscape. The stock price-to-sales ratio for Zeekr is multiple times that of its US-listed competitors. Hence, with a strong balance sheet, it's expected to do well in the US listings. With the relentless price war raging in the Chinese EV market, it remains to be seen how Zeekr places itself with respect to its competitors, NIO and XPeng, as EV manufacturers try to undercut each other in a tough game of discounts and price reductions. Zeekr seems to hold promise in the Chinese automotive space. Bold Chinese EV makers have decided to wade into foreign markets, inspired by Zeekr's recent US IPO success. With Zeekr's stock rising 34% in spite of US and Western protectionism against Chinese automakers, it seems that Chinese automakers have a good chance to rejuvenate their foreign market sales. To add to the fray, various other markets are being tested as well. Horizon Robotics, a Beijing-based autonomous driving chip design company, and its rival, Black Sesame Technologies, filed nominations to get listed on the Hong Kong Stock Exchange this year. This is a bid to attract investments from the Hong Kong population. CATL, the world's largest maker of EV batteries, is looking to enter the Hong Kong Stock Exchange while aiming to bring customers as stakeholders. The Zeekr success story is ready to invite a flurry of new Chinese EV IPOs to various foreign stock markets. That being said, Chinese offshore equities have improved this year. Hong Kong's benchmark Hang Seng Index has notched a 24% gain since a low point in January, while the Nasdaq's Golden Dragon China Index, which tracks 69 US-listed Chinese companies, including EV startups XPeng, Li Auto and NIO, have risen more than 20% from its January low, eyeing the increasing acceptance of Chinese automaker IPOs in foreign markets. It seems they have a bright future ahead if they choose to diversify to foreign markets. However, it's expected that Chinese IPOs might sell at lower price points because of the general awareness regarding stiff domestic competition faced by Chinese EV makers in their own country and their poor sales performance seen overseas. Initial investment interests in Zeekr were low in November last year when the company shared its prospectus first. This improved finally after it was listed at the US IPO. What happens to Zeekr's valuation in the long run is something that remains to be seen. However, there are some other factors to be wary of. Chinese President Xi's policies uncertainties, coupled with the near-Cold War between the US and China, might spell trouble for US investors looking to invest in Chinese EV shares. Even though Zeekr seems to be projected to do well in 2024, it's important to remember that Geely-backed companies have lost significant market share in the past, with their final stock price falling by as much as 60% since their first listing. There are other concerns for investors in the US as well. Green energy investments do seem to sound interesting and are a hot topic, but existing car manufacturers in the US are struggling to balance investments between their gas-powered and electric variants. To make EV variants available and standardized assembly lines, retooling and reshaping is often needed. While this is an important segment to invest in, the Inflation Reduction Act promises to increase investment to help the EV industry and the US manufacturers critical components needed to ensure self-reliance. Until this happens, however, the US will continue to depend on China for importing of batteries and other critical components needed to manufacture EVs. This might mean indirect benefits to Chinese EV investors through vested interests in the US market. The domestic EV market in China is not what it used to be. The days of booming demand and government subsidies are over. This means an oversupply of EVs in the domestic market, with very few potential buyers. Not to mention the shrinking middle class and the reduction of the purchasing power of the Chinese general population. Will this mean the Chinese EV market will go extinct? Maybe not. Chinese EV companies sprung up like mushrooms back when the government provided subsidies. But then, small, low-volume manufacturers started producing terrible quality cars. The government changed gears and decided to stop subsidies and support to EV companies. This means most low-volume manufacturers went dry, with brand new EVs licensed and registered, being sold off to retailers and finally being dumped into massive EV graveyards. This doesn't represent the complete picture though. The top 10 companies in China dominate the EV market domestically and now facing a hard time selling their cars. The economy is to blame, not to mention the tough competition they see in the form of offbeat brands entering the market, namely Huawei and Xiaomi. Surprising to hear your beloved mobile phone manufacturers making EVs? Don't be, because they are giving BYD and other top EV companies a run for their money. Oh, don't forget how Tesla struggled to even gain a foothold in the cutthroat Chinese EV space. All this means that Chinese EV companies are now being forced to look outwards. Outwards can only mean one thing: foreign markets. With diplomatic relations between China and the US being less than ideal, it's no surprise that Chinese EV makers are being forced to think creatively. Which markets to exploit and how to do so would be the first thing on their minds. Even in markets where they have a presence, they are doing that well. Other than gas-powered vehicles made by Morrison garages, very few companies have a significant presence in foreign markets. But what we must look at is how China can beat the slowdown and get ahead. One of the possible avenues on the horizon seems to be Brazil. It could be a potential market to enter into for Chinese EV companies. As President Biden in the US announced sweeping tariffs on Chinese EVs entering into the US, Brazil has decided to provide low tariff opportunities to Chinese EV makers. This could open up the Brazilian market to potential investment in the long run. The recent European Union, or EU, tour by the Chinese president along with Chinese automakers Envision Group, CAIC Motor, and Xpeng Motors may open up investment opportunities in the EU. This means Chinese automakers may target the EU market space, along with investment opportunities for the EU itself. We want to welcome more Chinese investors to France, President Emmanuel Macron is stated to have said. EU plans to ban combustion engines by 2035, and China's huge manufacturing capabilities, presently 60% of the global EU production, may lead to significant carbon-neutral investments. Since Chinese EVs are 24% cheaper than European brands, this could, however, spell disaster for Euro investors. Loss in market shares and drop in sales is likely to impact jobs and investor dividends. As their home EV brands take a beating in their own EU market, they fear losing market shares to China rivals in the long run. However, if emission goals are to be met, it's a must that Chinese EVs gain some momentum in the EU. We promise to bring you the latest content from across the EV market. Find detailed analysis and updates regarding such topics on our channel. For more such content, don't forget to like, share and subscribe to our channel. See you next time.